Cheryl and I, sit in there. Yeah. And I want Cheryl and I should say no either. I was doing there. Yeah.
All right. Chapter 6. Some of the stuff is still a continuation of what you learned in chapter 5. But the reason why we're spending so much time on it is because of the inventory methods. Learning those takes some more time. So we know about goods in transit, right? But just trying to figure out what is a part of inventory. And typically, what's a part of inventory is anything that is going to contribute to the inventory being ready for its intended purpose or use, which is to be sold, basically. So, goods in transit, all this means is that that is a part of your inventory count, even though it's on its way to a customer, it's still a part of the main inventory, physical inventory count. Goods on consignment, remember the seller, that's their inventory, they own it, even though it may be in a third party's location to be sold, it's still a part of their physical excuse me, inventory count. And then goods that are damaged or obsolete, of course, need to be written off out of the inventory count, but are still a part of it until it's time to write off. So we talked about these very briefly: FOB shipping point and FOB destination. So remember, when it's FOB shipping point, the freight charges are whose responsibility? The seller. The seller, right? Because that means that the seller pays for the freight to go, or pays for the freight for the items to be delivered to the customer. Whereas FOB destination point is kind of like a cash on delivery type of situation. So that means the freight is not paid for by the seller, it's paid for by the buyer once they receive the goods. Now, goods on consignment. Remember how I said those are the inventory items where they may be in a third party's location, but the owner of the inventory is actually the seller, because it's just sitting there, kind of like storage. It's just sitting there until it's being sold, and once it's sold is when we deduct it from inventory. Goods that are damaged or obsolete, sometimes this happens, and so if it is damaged or obsolete, then it's not counted with inventory if it's something that still cannot be sold. Sometimes things are damaged, but they still find a way to get some kind of money from it, so we have to put that as a part of our inventory count. But if it absolutely cannot be sold, then we take it out, and the cost will reduce net realizable value or salvage.
Just a quick question.
Uh-huh.
On that realizable value, how does that play into the actual cost that the purchaser bought the thing at? I mean,
It doesn't.
It doesn't at all?
It doesn't affect it.
So it's almost
Just
like
because
a
they're
depreciation type of
no, it's not the same as depreciation. Depreciation would be accounting for usage of the item. The item can't be used. So since the item can't be used and you're just trying to get it off of your books, it's more so similar to salvage than depreciation itself. But it doesn't affect what you paid for it. Even though it's damaged and you can't really sell it for what you intended, it doesn't affect what you originally paid for it. So the invoice cost, that's not just the actual product. It would be the inventory, any kind of discounts and allowances, you subtract those out. Import duties, these companies that sell overseas, import, export, they pay a duties fee, they pay freight charges, you might pay for storage, and of course you have to pay for the insurance on the item as long as it is in transit to the buyer. So what are some good internal controls, some things that we must do to make sure that we don't have any theft or anything like that as far as inventory is concerned? Most companies take a physical count at least once a year. Now, if they were doing a physical count at least once a year, that would be up under what inventory system, perpetual or periodic? Periodic, because it's by the period. So meaning every 12 months. With perpetual, you count inventory on a frequent basis. So as things are sold or purchased. When the physical count does not match the inventory, the merchandise inventory account, then you have to make an adjustment at the end of the year, of course, or at the end of the period. Now, the way that they had some traditional good internal controls was, pre-numbered inventory tickets. The ones who count the inventory don't actually keep up with the inventory constantly. They're just the person that counts it at the end of the period. When they count, they confirm the items that exist, the quantity that exists, and the quality of the item, whether or not it's sellable or damaged. And somebody always does a second count, and then of course the person that is in charge, the manager, will confirm what numbers have been presented. But of course we know we live in an age of technology, so now inventory is a little bit different. It's more automated. A lot of retailers, because they have a great POS system, as they sell these items, it takes away from the count of what it was originally scanned in. So they have more preventative quality control measures. So inventory costing under a perpetual system, um, which means we count it as we sell it. How does it affect the balance sheet? Of course, merchandise inventory is affected, right? Cost of goods sold is affected. And then the income statement, we account for the sales from the inventory that we've sold, the cost of those sales, and any allowances, refunds, returns, discounts, and so forth affects the income statement. So what are the cost flow assumptions, which we're going to talk about in length? Meaning all items in merchandise inventory and their costs, the different cost methods. We have specific identification, we have FIFO, LIFO, and weighted average. And I'll tell you what each one of those mean. An inventory system, perpetual or periodic. And sometimes, even though they may have a costing method in place, such as specific identification or FIFO or LIFO, or even weighted average, the inventory just has such a low value that we have to go based upon what the market says it's worth in order for us to value it. Now, FIFO. FIFO stands for first in, first out. What does that mean? The inventory that you purchase first is the first to go out when it's sold. LIFO, last in, first out. Meaning the last amount of inventory that you purchase is the first amount of inventory to go out when you sell. So what does that mean? Who would normally operate in a FIFO situation? Probably grocery stores, right?
First in, first out.
First in, with perishable items.
Retail.
Not retail, but grocery stores for sure.
You don't want your
If you got vegetables and fruits and everything, they only have how much of a shelf life?
I mean, right, but they would still.
They wouldn't use LIFO, that's for sure. Wouldn't you want to sell a bell pepper that you purchased 2 days ago versus last week?
True.
So, but retail could probably go any way. They could do FIFO or LIFO. And a lot of that also depends on the accounting principles that they're governed by. You remember GAAP and IFRS, right? Well, GAAP says you can use any one of the costing methods you want. The only key is that if this year you use FIFO, I'm expecting for next year you to use FIFO, and if you switch to LIFO, you can't switch back to FIFO right away. You would have to keep doing that consistently. Whatever assumption you have, it has to be consistent from year to year. Whereas IFRS, they don't want you to do LIFO at all. So they don't let you do, you can't have a LIFO costing method for your inventory under IFRS. And why? IFRS stands for International Financial Reporting Standards. What that simply means is this: I would rather you keep the most value possible on your inventory, so I'm going to make sure that you can't use LIFO and that you sell your first items that you purchased first to get them off the book so that you are not stuck with inventory that you obviously can't do anything with. Does that make sense?
Okay.
Will cell phone companies follow the, LIFO? No, that's FIFO.
It might be beneficial for them to do FIFO to get because I guess with phones they become obsolete really quick,
Very
right?
quickly.
Yeah, and especially like these iPhones and stuff like that, they every time you get whatever was the newer one, another one comes out. So FIFO probably would be more beneficial for them. What companies would be more LIFO? Car companies, like dealerships. When you go to a dealership, don't they try to give you whatever is the newer car, right? Maybe the current year or within the last 2 years,
Well,
right?
I thought you were trying to find where you, so FIFO would be car company.
LIFO.
Last in, so when you go get a car in 2016, they gonna give you a 2017, cause that's the latest in. What about a gas station?
I don't know if you would count them as inventory, but
So in a restaurant, if they've got their inventory and they push, it would be the first, yeah, right.
yeah, but think of it in a different way. I use grocery stores because they actively count inventory. A restaurant might count inventory how often?
Every week.
Not of your food that you're serving.
Of everything else you mean? Oh, okay, yeah.
That's probably once a year, right?
Every day.
Not the food.
We're
you're
talking
serving.
about like your pots, your
Everything,
pans,
right?
your
Everything,
restaurant
yeah.
equipment.
Yeah, not
Yeah, we
your,
don't-
because I mean, you can't really put a price on inventory of the food that's gonna be cooked and sold, you know? But the other things that you have that are obviously inventory and assets, you would do that probably once a year in a restaurant, whereas a grocery store, they sell food for product, right? Farmers markets, they sell food as a product. And so they have to count things as it happens daily. That would be more so FIFO. I say dealerships as LIFO because honestly, I don't know what dealership doesn't try to sell you whatever the current year card is or the upcoming year card is, before they put you in something used that's not of that current year or the last 2 years. Weighted average, that's the interesting one because the price per unit changes as things are sold. And I'll show you an example of that in a minute. If you look at this graph down here, the reason why you see this LIFO, this is probably the percentage of companies right now in the US that use LIFO versus FIFO, because it's probably more beneficial for them to get whatever came in first, out first.
So what about superstores?
Superstores?
Are there stores that use both, like say Walmart, for instance, within their financial department, it'd be kind of weird for them to have a FIFO when they've got a grocery store and a clothing store, or you know, a hardware and all that within one store. So do they use two? I
You
mean,
can't use two, that's against the principle. You can only use one.
so how do they account? So okay, so what kind of system would you set that up in that?
Whatever is the majority. So yes, Walmart has these supermarkets inside of them now, right? But the majority of their product is where? On the retail side, non-perishable things. So they're gonna probably pick the majority for that. But you can't use two accounting methods within one period. You gotta pick one. And I would go so far as to say Walmart would probably be more beneficial with a weighted average method instead of FIFO or LIFO.
Explain that, I don't understand what that means.
Well, I haven't showed it to you yet. So you haven't seen it yet, so you don't know how weighted average works. But weighted average just means I'm gonna sell the items at the cost of the average cost of everything that I have on hand. So if I have 30 units on hand at $20 and I got 30 units on hand at $10, That means total inventory is worth what? Who has that calculator with them? See if I can do, okay, so if we got 30 items at $20, right? And I said 30 items at what?
10.
$10. How much is this inventory worth? 200.
600, my bad.
600. All right. What's the next one? 300. So that means I got total inventory worth 900, and I have a total of 60 units, right? And let's just say now I need to sell 40 units, right? And so what I'm gonna do is
So it's $15.
$15. So now when I sell those 40 units, I'm gonna sell them at $15, right? How many units do I have left? 20 units left, and they're gonna be at $15 now. They probably were at $12 before this. Probably were at $8 before this. So you take on the new average price for what's being sold until you purchase something else. And then the units change, the amount of inventory you have change.
That seems complicated.
So you said you're gonna sell the
Not really,
so you're gonna
but
sell
we're
the
gonna go
40
forward and you'll see it'll make more sense.
You said you're gonna sell the 40 at 15?
40 are at 15. But then we subtract that from our available inventory of 60 now, right? So we have 20 left over, and now the new price is $15.
So I got a question.
Mhm.
Just real life application using Walmart.
Mhm.
Walmart buys a myriad of things. So
Yes.
they get a shipment in at one point, that's majority electronic. That takes their average cost per unit for the whole store up?
Not for the whole store, because they're broken down by departments, right?
Okay, so just be within that department. Each department would have an average unit. Okay.
Might have an average cost per unit.
So now, is that the same thing that they do like for gas? Like where it changes based on
That's
how
where
they're
I'm a little
purchased?
iffy on that, because I mean, you can't count gas. I mean, I know it's a natural resource, so we count that in depletion and usage. We don't necessarily count it in physical units. So it's a little hard with things like the natural resources and minerals and everything. But that's a good question. It's something that I probably need to research. Okay, see if you can grasp this. This carver had 17 units, right? 3 of them were damaged and can't be sold. They had another 5 units sitting in the truck that are going to a customer, and it's terms FOB destination. And another 11 units out on consignment. How many units do they have left? Or what's the total count of the inventory? Started off with what? And what happened? 3 damaged. So we subtract those. What else?
5 more.
We add them or subtract them? Add them, 5 more, okay. And what else? What happened? What do we do with them? Add them.
Wait, why are we adding that?
Because we still own them. They're just on consignment. They haven't been sold yet.
Gotcha.
So, what's this amount?
33. Well, you got 33 usable units, 3 subtract 3 out.
30.
30.
Final answer?
30.
That's correct, right? Okay, let's go on to the next part. This is saying now that they want to acquire this piece for $1,000, right? FOB shipping point. And FOB shipping point, and the additional cost to obtain it, good morning, is, and offering it for sale includes $150 transportation in, $300 for import duties, $100 for insurance during shipment, $200 for advertising, $50 for gratuity for the delivery person, $75 for the store lighting, $250 for sales staff salary. What are the inventory costs of this transaction? What do we include? What don't we include?
The iron-based fixtures.
The fixture, because the original cost is $1,000, right? What else?
Shipping?
The shipping, we add that for $150. What else?
Import duties,
The import duties for $300, we add that.
insurance.
$100 insurance.
The lighting.
Mm,
Yeah, that's it.
That's it.
that's it. How much is this?
What is the $50 on? That means 10.
$50. Oh yeah, gratuity.
Okay, yeah, no. Okay, yeah, that's it.
So what do we have here? 1,550. So look what it says here in red. Key point, what are the necessary costs to get the asset ready for its intended use? So the cost of it, which is the 1,000, the transportation and the import duties and the insurance costs. Now, why don't we include the advertising, the gratuity, the lighting, and the salaries?
That's it.
Because those are sales. Those are sales.
No,
Those aren't inventory expenses.
we don't include them because it's just like it says in the red. None of that is required in order to get this asset ready for sale. None of it. You can go without advertising. You can go without paying a delivery person gratuity. You can go without store lighting. You can go without sales staff salaries, and that asset will be available to be sold without all those things.
That makes sense.
But it cannot be sold if you didn't include the transportation it took you to get it there to you to be sold, the import fees that it took in order to get it to you, the insurance on it to make sure nothing happened to it while it was on its way to you. So those things are absolutely needed in order to sell it, right? Okay, back to that whole FIFO, LIFO, weighted average. First in, first out assumes cost flow in the order in which it incurred, meaning I bought 10 items. When I go to sell, the first thing I pull from is what?
That's an item.
The 10 items. LIFO assumes cost flow in the reverse order in which it incurred. I bought 5 units last. When I go to sell 2 units, I'm going to pull it from what? The last 5 units I just bought, right? Weighted average assume cost flow at an average of the cost available, which I tried to explain that, but you said it was confusing, so we're going to try it again. Okay, this is the situation here. They have beginning inventory, they've purchased, they've sold, they purchased, and then sold again. So averaging all, after subtracting out what has been sold, they are left with 55 units. Sold a total of 43 units. The 55 units that are left are worth $5,990. Now, here are the assumptions. This one is very irrelevant, but this is specific identification. Notice they sold 20 items. And we know under the other assumptions, we would have either looked at what was purchased first or looked at what was purchased last. But with specific identification, the company gets to choose, for whatever reason, where they want to pull the inventory from. So if they want to choose to pull some from the beginning, they can do that. If they want to choose to pull some from the end, they can do that, right?
And what pulling it for what? I'm trying
To sell it.
Okay.
Yeah, to sell it, they choose where they're going to pull the inventory from. That's under that method. But if you look under FIFO, oldest cost, cost of goods sold, recent cost, ending inventory, same example. They sold 20 items on August 14th, right? Before August 14th, they had a beginning balance of 10 units at $91. They had purchased more units, 15 more units on August 3rd at $106. So that means total inventory was worth 2,500, and they had a total of 25 units in inventory by August 14th when this sale took place. So they sold 20 units. So where do they pull units from first?
The beginning balance.
The beginning
91,
inventory, right?
91, yeah, the
So they had 10 in beginning inventory at $91. So they pulled 10 of those under FIFO at $91, and then they pulled the remaining 10 from where?
From the 106.
The next set, which is 15, from 15 at 106. So that means they have how many units left in inventory after this? 5 units, and it's at 106. Now we move on. They purchased some more items. They purchased 20 at $115. So now we still got 25 units, 5 at 106, 20 at 115. On August 28th, they purchased more units, 10 units at 119. So now we got 5 units at 106, 20 units at 115, and 10 units at 119. August 31st, they had a sale, and they sold 23 units in total. So they're going to pull units first from where?
The 5.
The first 5 up here at 106, right? Because that's what's left over. So they're going to pull 5 at 106, and the rest of the 18 from where? Right here, 20 at 115. They're pulling them from the 18 from there. So now that means we would have how many units left?
12.
2 at 115 and 10 at 119 for a total of 12. But knowing what they cost is very important. Don't just group them all together and say, well, we got 12 units left. This is going to be 2 at one price, 10 at another price. Where
Except
is,
for under the weighted, then it doesn't matter.
right, but we haven't got there, so I don't want to confuse anybody. But this is just under FIFO. We're pulling from the first, whatever is on top.
So like say, for instance, you've been using Walmart.
Mm-hmm.
I go to
Y'all love
Walmart,
Walmart. Why are we on Walmart?
Cause you said Target.
I didn't say Walmart.
or Target or any
He brought up Walmart.
any retail place, something like that. If I go in there and the TV says it's $200, they
Mm-hmm.
bring TV from the back that's first, and they say, nah, this one costs a little bit more because it's the first thing.
No, they
Well,
can't
we
do that.
wouldn't assume, the
They
consumer
can't do
doesn't,
that.
consumer doesn't.
This is based on the cost we pay.
Right.
When they're selling it, they're gonna sell it at whatever price they put out for it. You're not gonna know if that came from the first batch of inventory or if it just came in. You're not gonna know. They know, however, where it came from. So when they scan it out to you, it's gonna say, oh, we purchased this at that price. Whereas when they sell it to somebody else, they probably purchased it at a higher price or a lower price. You just never know. What's that?
Walmart had them big, huge central warehouses, and all the local stores pull from those warehouses.
Right.
As they going around with those guns at night, they're actually placing orders in trucks, actually picking them up in the city warehouse and bringing them to the store.
I guess his point was, can they just come and say, well, I purchased this first, so I'm gonna sell this to you at $200 because this was purchased first, whereas, you know, could have paid. They don't do it that way. The person who's buying it would never know what stock it came from. Only the store themselves would know. Okay. LIFO. Now it's a little different. Same transactions, different costs. Still have beginning inventory. You still have purchased on August 3rd. Now, when they sold on August 14th, they still sold the same 20 units. But this time around, where do we pull from? The last. So how many units? You're selling 20 units, and you're pulling from what was purchased last. So what do you pull from?
The 28th and the 17th.
28th and the 17th, right? So 20 units in total. Back on the 28th, they only purchased 10 units, right? So you can only get how many units from? Oh, no. Hold on. Yes. Don't go all the way down here. I'm sorry. You're doing by what's last. So as of August 14th, the last purchase was really on August 3rd. Does that make sense? So in that case, only 15. You can only get 15 units from what was last purchased, and you're gonna pay 106 for them. And then the remaining 5 units that you're selling are gonna come from the beginning balance up here, right? Whereas down here, this sale, they're going based upon the 28 and the 17. So it's gonna be 10 at 119, 13 at $20. No, I'm sorry, $115. Does that make sense? Is anybody confused?
Why are we missing the first two? Did we do all this first and third? Did I miss that or something? You want me to shut up?
What did you miss?
No, I was asking, did I miss when you went through the August and third?
I was saying for this sale that happened here on the
Oh,
14th, where do we pull from? And that's why I just drew the arrows,
Okay.
because that's where we pull from. Last.
Oh, so he just automatically gets the bottom.
Right.
Yeah.
But that's why I was explaining to
I
him
did
that.
it.
That confused me. I was like,
Yeah, and then down here when we saw, we took last. Everybody see that? Does it make sense? This is just for LIFO.
Where you get the 13?
They sold 23 units. And we pulled the little 10 that we could from whatever was last here, and the remaining 13 units, we had to pull it from the 20 that was before that. Any questions about this, Ms. Banks? You have a question?
What's the when would that be more financially beneficial? I'm trying to understand in the concept of how they use, what's the difference, like. what
You'll
is
never
it?
understand that, because it's gonna be based on the business. All that you need to understand is what to do when they have, because even these companies that you are researching for this project, each one of them use a different costing method. Some of them might, what are some of the, I know Apple is one. Ford, what, Lowe's, and definitely that one, I know. Procter and Gamble, them too. So you're all dealing with companies that have a substantial amount of inventory. It might help to look on the annual report and see what cost flow they choose. Okay, because it's going to be beneficial in different ways for different companies. Like for Ford, it wouldn't be more beneficial for them to. It seems like it would, but it wouldn't. It wouldn't be more beneficial for them to get rid of old inventory first. Because cars keep a range of, what is it, like 5 or 6 years on their lot. I don't think they really go beyond that. So you can't go on a lot these days and get something that's in the 90s as far as a car is concerned, right? So I think they stay within the 5 to 6 year range. It would be more beneficial for them to get rid of the new stuff that they have than get rid of the old stuff first, because the new stuff costs them more money. So they want to get as much as they possibly can off of it, because we know cars depreciate by the day. The moment you crank it, the moment you put it in drive, it depreciates.
Most of y'all won't know what inflation is.
Well, no, we talked about it in here because we had to talk about depreciation, right?
Yeah, if you're in an inflationary economy, Federal Reserve System, central banks now master inflation. The inflationary economy, it will have a big impact on financial statements, not necessarily on corporate goods. So like in some of the countries now where they still have big inflation, one of the reasons I think national financial accounting ban LIFO is advantageous from the financial statement. The price is going up and up and up each time you buy.
Thank you for that, Mr. Did you know that before?
Because you hesitated.
No. Going over to check the email and no, not today. No, he's absolutely right. When prices on imports and exports inflate, they do whatever is the accounting principles are designed and put in place to protect investors and protect stakeholders. And so the best way to do that is to make sure that they are not losing enormously. on these imports and exports due to inflation. And why do we care about a company whether or not they're losing a large amount of cash? Well, for one, they have shareholders that they have to pay back. Two, they're on the open stock exchange, right? So that means there are many stakeholders involved. Also, we don't really talk about this in this class, except for in the very beginning, but there's such thing called fraud and violation against SOX, right? Sarbanes-Oxley. And what happens is that creates a opportunity for companies to start overstating on their financial statements, which we know is against the law. So
But don't they do it all the time?
they do it, that's because of greed. But we don't want it to be a situation where we create an opportunity for them to do that just because of inflationary costs. Okay? So it's one thing to do it because you were just greedy. It's another thing to do it because the economy left you no choice but to do it. So it's a little different. So we understand LIFO, right? No? I think. What about FIFO? Do we understand where those costs came from?
I did FIFO, I'll have to watch.
And I'm just gonna draw the arrows here as well. So first, okay. What's the first? Weighted average. Write this down. Cost of goods sold available for sale divided by what? Units on hand on the date of sale. Cost of goods available for sale divided by units on hand on the date of sale. Got it? Got it now? All right, so weighted average. Just walk with me through this. So we got the beginning balance of those 10 units, right?
Right.
And $91. And then on August 3rd, we purchased 15 units at $106. So now we have 10 units at 91. We got 15 units at 106 for a total of how many units?
25.
25 units, and at what price? They're different prices, right? But total up right now,
It's 2,500.
2,500, right?
Okay, so 25 divided by, okay.
So in order for us to sell here on August 14th, those 20 units at the new weighted average price, we take the 2,500 units and we divide it by, the 2,500 total cost and divide it by 25 units, which equals $100. So now that's what we sell the 20 units at on August 14th. Does that make sense? And now,
So this will be used for wholesale.
girl,
I'm just trying to figure it out, because like it does, okay.
okay. All right, so now it's $100 per unit, right? And then on August 17th, we purchased 20 more units at $115. So now we add our 5 remaining at 100 plus 20 at 115. We have a total of 25 units again. And now at a total price of $2,800, We're adding more again, so now instead of 25 units plus 10, we got a total of 35 units here. They're all at different prices, right? However, the total price is $3,990. So when we go here to sell these 23 units, we're selling them based upon 3,990 divided by 35 units, which equals 114 as the average unit cost now. So that's what we sell these units as, 114. So at first the cost was 100, right? Then it went up to 114 per unit, and the remaining 12 units we have there at 114 until we purchase more or sell more. Now, she said, where would this work best? Again, it's gonna depend on the business, but I can see how a wholesaler would be more comfortable using this because it makes things easier for them as units are purchased and sold. It just makes it easy to use whatever the average cost is, right? Maybe. And so, let's try this. I know it looks like a lot. It says company uses the perpetual system. Determine the cost assigned to ending inventory and the cost of goods sold using these four assumptions. It says round per unit cost and inventory amounts to cents. For specific identification, ending inventory consists of 10 units, where 8 are from the December 30th purchase and 2 are from the December 8th purchase.
What?
I know.
Okay, I'm leaving.
No. You are basically stuck in the class at this point. It's after bedtime, so you need to be here. All right. Regardless of the method used, the cost of 26 units are included in cost of goods sold, and the cost of 10 units are included in ending inventory. Now, specific identification. Not an inventory assumption. We go by what's actual, right? Cost of goods sold represents the actual cost of the unit selected by the customer, and any inventory represents the actual cost of the units that remain in the inventory. So how does it work? Here are all of the units that have been sold or purchased, right? So it says cost of goods sold is going to be what? The exact? Yes? Yeah, it is. It's just the exact. So on December, you know what? December 8th, December 9th, they sold 8 units, right? So what are they going to sell the 8 units at? 450. Why? Because that's what was where they're pulling from. That's the exact cost of it anyway, right? When they sold 18 units, what happened? No, not at 450. I'm sorry.
Okay, yeah.
We paid 450. We sold it at $5.30. And why did we do that? Because that's exactly where we pull from. It's exactly where we pull from here. This is not the method you need to be most concerned about, so it doesn't matter. However, the 2 that we sold here came from where? 450. Yeah, so it's just basically saying wherever you pulling from is the exact cost that you apply to it.
Okay, so specific identification is basically a fourth way of handling inventory.
Yeah. It's a
Okay.
way of handling inventory. It is a cost method.
Okay.
However, not many people choose it because it's not as significant if you're just only selling it at the same cost that you purchased it. What money are you making?
You know? Just break it even if you do that, right?
So this is why this is not a preferred method. And please do not get hung up on it. Please. Because it's not gonna be the one that's tested. LIFO and FIFO are what you need to be concerned about in your weighted average. Let's try FIFO. We know the beginning inventory was 5 units. We purchased 10 more units, so they gave us a total of how many?
15.
15 units, and there were 5 at $3 and 10 at $4.50, right? On December 9th, we sold 8 units.
So we're gonna pull the 5 and 3 and 2 more at 450.
So you're gonna pull 5 here. Five there, and then 2 from there, which means that you have how many units remaining in inventory at that point?
One,
Oh, you have 8.
8 units at $4.50, right?
Right.
how do you get 8 if you pulled it?
Because you got
How many
5
did
from
you
the
pull
top.
from it?
You pulled 5 from, and then left you with 2,
And you pull those from where?
The 10.
or to add to the 10 to make it.
To pull from the 10. You sold 8 units.
Oh, I'm pulling it.
It's
I'm
being
taking it
sold.
away. Okay, I got you.
Mhm.
Okay.
So you have 7 units remaining at $4.50, right? Then on the 19th, you purchased 13 more units, so now you have 7 units plus 13, which means a total of how many units?
Wait, we have 8 units.
Why do you have 8?
Because we pulled the 5. Oh.
6,
Oh,
7,
never mind.
8.
Okay,
Yeah.
my bad. So we have 7.
7 units remaining,
And then we
plus 13 we just purchased.
Okay.
So why do those total units not add up in terms of whether you sold that? It says units at $7. At $7 each? Is that what it's saying? Is that some kind of average?
Well, the
between that?
$7, why are you concerned with the $7?
Well, because, I
That's
mean,
just saying what
8
it was
units,
at
I'm taking.
They're
it says initially
saying-
that the cost of the units, where it says 5 units at $3, right?
Right?
And then you got 10 units at $4.50.
Yeah.
So the $4.50 would pay for the total 10 units, is that correct?
Yes.
Okay, okay. And then you got 8 units that you sold at $7.
Well, no, those eight
That's what's left
units
over.
were sold, but that's retail. We're talking about cost and
Correct.
retail. So the
Correct.
retail is where they make their profit, but the cost is what it costs us.
Ignore this and
Right.
ignore this.
Right.
All we're concerned about are the units that are being sold and what it costs us to sell them. So 13 plus 7 units.
To wrap up this one,
December 24th, we sold 18 units. So where do we pull from?
we're gonna pull the remaining.
Pull from the
3.
7 at $4.50, and then do what?
Where's 18 units at?
It says it up here, December 24th, sold 18 units. Can you see?
No.
Oh, you
Wow.
bought 13 more though,
Yeah,
that's
you know my
right.
glasses is no good. Oh, okay. I gotta get some more.
Why you glasses on?
Don't go to Lens Craft to get anything.
You got that right, they will mess up your prescription in a heart.
Jesus.
Okay,
I ain't lying.
I'm glad you told me though. Okay, so they sold on December 4, 18 units, so we pulled 7 from the remaining at $4.50, and then we pulled the other 11 units from,
The 13 at 5.
So what we're doing here, so I understand for this home.
Go ahead.
So I want you to send you all this email. When it says 18 units, I got to see where I'm gonna pull them from.
correct?
So that's how, cause it's saying I have to have 18.
Well, they're
Well,
saying that you're selling
Yeah,
18.
I'm selling 18, so now I gotta go pull it so I can sell it.
Correct.
So I'm gonna pull it from.
The inventory
FIFO.
that you
What's the
have
name
on
of
hand,
FIFO?
first in, first out.
First in, first, okay.
So again, going back here, right now, you have 13 plus the 7 units on hand, right? Which gives you how much? 20 units on hand. We're selling 18 of them, right?
Mhm.
So 7 of them are gonna come from this first cost.
Right.
The remaining 11 are gonna come from this next cost
Okay.
after that.
Okay.
So then,
Okay. Okay.
see that now?
Yeah.
7 at 450, 11 of them at 5. So that leaves us with how many units in our inventory after we sold 18?
Two.
2 units, and at what
$5.
price?
Fine.
Oh, like $5.
$5.
Okay.
And then,
And we
we purchased, yeah, on December 30th, 8 more
8
units.
more units.
So now we went from having 2 in the inventory to
Having 10.
10. 2 at what price?
$5.
5.
8 at.
$5.
So how do we calculate cost of goods sold? Well, all in all, it cost us what?
$115.
Everything we purchased, because that's what you gotta look at, right?
So the cost of goods sold was $115.
Mm-hmm.
And the
But where does that
inventory-
come from?
From all the units, I add that up. We're gone.
Bye. Okay, so cost of goods sold comes from what has been
From the units that's the price that been sold out,
purchased.
that we purchased.
Why does the goods available for sale reflect both the cost of goods sale and the ending inventory? Wouldn't it just be the ending inventory? Because that's what's available for sale.
Because you gotta know what you paid for it in order to get the value. But before we get to that, because I think y'all are passing over what I'm asking,
Oh, I'm sorry.
where does our cost of goods sold come from?
The purchase prices? The 45, the 65, and 4240.
So, well, technically not the 4240. Why do I say that? This is why it's so important. Purchase 10 units at 450 equals what?
$45.
45, and then 13 units, that was the $65, right?
Right.
And then here we had 4250. I mean 4240. All of this added together equals what?
152.40.
152.40. Now that typically would be your beginning cost of goods sold, right? Out of what you've sold.
What about the beginning inventory?
Yes. Add $15, 167.40. What has happened? You sold items, right? You sold 18 units and then 8 units. What did you make off of that?
$28.50.
Just $28?
What?
Oh, I thought I'm looking at the price at the $8.
You said, what did we make off of it? What we sold it for?
It said 8 units, I think we had 8, so.
Basically, how many units did we have left on hand, you told me?
We had 10.
10.
Two left. I mean, 10.
They total 52.40, right? So if you subtract that 52.40 from 167.40, what do you get?
Okay, so the one,
Answer my question.
115.
115. Subtracted from the 167, the 115. The cost of the goods sold subtracted from what you
Subtract ending inventory from 167.40, which was your beginning cost of goods sold. Equals 115, right?
Okay.
I just want you to see where the numbers come from.
Yeah, 'cause we-
So again, the question was, well, where does the 115 come from? When you subtract your ending inventory from the cost of goods. 167.40, you get the ending cost of goods sold, and then you take that ending cost of goods sold, add it to add it to ending inventory, and you get goods available for sale. What was your question? You had another question that you were.
Me?
Yeah.
No, it came out, it came out right, I mean, 5240, that's the number you're looking for, correct?
Yeah, what you really want to find is what your ending inventory is, if nothing else, which is however many units you have on hand times the price that you have them. And then subtracting that from overall cost of goods sold to get the ending cost of goods sold.
So this bottom 115 is ending cost of goods sold, but what we just calculated up there is just basic beginning or total cost.
Or even if you don't call it cost of goods sold, you can say cost to acquire inventory. It's all the same.
Okay.
But I look at it as beginning cost of goods minus ending inventory to equal ending cost of goods sold.
Okay. And then the goods available for sale.
Is your cost of goods sold amount minus plus the ending inventory. This is under LIFO.
Okay, so LIFO is last. Okay.
So you're just going in reverse order, right?
Right.
Everybody? No? Ms. Warren? Follow? Okay. So if we're going in reverse order, we know we had a sale on December 9th of 8 units. So we pulled from the last of where?
Which would be the 8th, 10.
The 8th and the 1st, right?
Right.
So on the 8th, we had 10 units. That was the last purchase. We're only selling 8, so we can pull that from that 10.
Right.
Right? At that price. Follow so far? And then go on December 19th, we purchased more. December 24th, we had another sale of 18 units. So where did we pull that from?
We're gonna pull that.
What was the last purchase?
The 19th.
The 19th. So we pull
13 from there.
13 from 5,
And
2 from
from the 9th.
the 8th,
Okay.
Cause it's 450.
2 from the 8th,
And then,
3 from the beginning inventory. So we're just going up in reverse, right?
okay.
And then, so that means we have we had another purchase on December 30th for those 8 units. So what we really had on hand was what, 2 from beginning inventory and then the 8 that we purchased now. And a lot of people always say LIFO is the easier one for them to do than FIFO. What changed?
The ending inventory.
Ending inventory, and the reason it changed is because we went in reverse, right? So the unit prices were different. What about weighted average? We didn't sell anything until December 9th, right? So when we sold on December 9th, those 8 units, we had to figure out what price to sell them for, right? We started off with 5 units at $3, then purchased 10 on December 8th at $4.50. So that gave us a total of how many units? 15 units. And they were worth $60 total. So $60 divided by that 15 gives us an average cost of what? $4, which means when we sell these 13 units, we're going to sell them at what?
$4.
We're going to sell how many at $4?
Champagne.
I just see 7 down there, say $4.
You
What
sold
did we
8.
purchase?
You
We
sold
sold
8
8.
units.
Oh, excuse me.
So you sell those at, no, you were right. You were right. You sell 8 at $4, right? How many do you have left from those 15? 7 units. And they're going to be also at what?
$4.
$4.
Until we purchase them.
Purchase more, 13 more on the 19th, and then on the 24th we sold 18 units, right? So how do we figure that out? It's the same thing, right? the 7 units you had remaining plus the 13, right? Total of 20 units, right? Then it was all worth $93. So 93 divided by the 20 units gives us what average cost?
465.
$4.65. So now you're gonna sell 18 units at $4.65, and you're also gonna have how many remaining units at $4.65? 2 units at $4.65, and then we turned around and purchased 8 more units at $5.30. So now we have a total of how much in ending inventory? 10 units, and there are 2 different prices. And I think it might be safe to stop here. You said 3.